Joining us now for Insight, Kathryn Rooney Vera, Chief Market Strategist at StoneX Financial. Kathryn, great to see you. Good to see you in person. What do you think? BOE 7, Fed 6?
There's a chance. Certainly, I think the Fed is going to go to 550 and the BOE 6.5 by March of next year. But given the trajectory of service inflation in both economies, service-based and consumption of service-based, I think there's a very good chance that we could surprise the market, or the central banks could surprise the markets, which would be a big downside for equities.
Kathryn, what do I want to do in this environment? If that is the case, do I just stick in a money market fund, wait to buy duration? Maybe the opportunity hasn't availed itself yet. Watch potentially stocks crack under the kind of the heat of these rate hikes. What do you think the market's going to do with all of this?
Well, as our rates team at StoneX says, something has to break. The Fed has to break something to achieve the 2% target. And more likely than not, the Fed has to break the labor market. The labor market remains, we saw that gangbusters report of ADP. We can debate the accuracy of it or not, but the trend is there. And the trend is that we're at full employment with a 6% fiscal deficit. So that in and of itself, that combination is potently inflationary. So something's got to give. And if I'm right, and it's the labor market and wages have to plummet, and we see some layoffs, we see JOLTS go lower than the 9.8 that was reported today. We see the quit ratio drop because people are less positive that they'll find another job. Then I do think you want to rotate out of the discretionary services and tech names that have done so well year to date and move into those sectors that have not, which are the more defensive ones.
But here's what we've been seeing is that you can be absolutely right.
Yeah.
On an economic level and on a market level be absolutely
Get the timing wrong. Yeah, it's about timing.
It's not even a question, I mean, yes, it's a question of timing, but also the FOMO then winds up sucking you in too. So there is a reasonable alternative to equities. It's the bond market, yet you still see FOMO. Maybe not today, but how do you manage that?
Yeah, Tina's gone because it's the complete opposite, right? You can look outside of equities. You can look at gold and fixed income, even in emerging markets. I mean, you can get long duration, hard currency paper for juicy yields. But I would be careful because I do think that the markets are underestimating the ability and the willingness of the Fed to effectively break something to achieve that inflation fighting credibility that some argue it has really lapsed on.